The Federal Reserve Governor Michael Kiley reaffirmed the central bank's dovish stance on interest rate cuts for 2025. He emphasized that the Fed is committed to achieving its dual mandate of maximum employment and price stability. Kiley's comments came as a reminder that the Fed has been closely monitoring economic indicators, including the labor market and inflation rates. According to data from the Bureau of Labor Statistics, the unemployment rate has remained below 4% since 2022, indicating a strong labor market. In terms of interest rates, Kiley mentioned that the Fed is keeping its options open for future cuts. However, he also emphasized that any decisions on rate changes would be based on economic data and not speculative predictions. The current federal funds target range stands at 5.25% to 5.50%, with a neutral stance from the Fed. A look at historical data shows that interest rates have been on a downward trend since 2018, with some fluctuations in between. As of January 2024, the median household income had reached $71,000, up from $67,000 in 2022. This increase in income could lead to higher consumption and economic growth. Kiley's comments were seen as a reiteration of the Fed's commitment to its dual mandate. The central bank aims to achieve maximum employment and price stability by adjusting interest rates and implementing monetary policies. According to data from the Atlanta Federal Reserve, the GDP growth rate for 2025 is forecasted to be around 2%, with some economists predicting even higher growth rates. The Fed's dovish stance on interest cuts has been a topic of discussion among market participants. While some analysts believe that lower interest rates could boost economic growth, others argue that they might lead to inflationary pressures and asset bubbles. Kiley emphasized that the Fed would carefully consider these risks before making any decisions on rate changes. Despite the uncertainty surrounding future interest rate moves, one thing is clear. The Fed will continue to prioritize its dual mandate of maximum employment and price stability. As Kiley noted, the Fed's primary objective is to promote a strong labor market and keep inflation in check. With this commitment in mind, investors and market participants can expect the central bank to remain vigilant and responsive to changing economic conditions. In conclusion, Michael Kiley's comments on interest rate cuts for 2025 reaffirm the Fed's dovish stance. While the exact timing and magnitude of any future rate changes are uncertain, one thing is clear: the Fed will continue to prioritize its dual mandate and respond to evolving economic data.